Hi, everybody, and welcome back to the Oil and Gas Rundown here live at King Operating. We are thankful that you're joining us today as we again jump into what is happening in the oil and gas industry, also taking a look at some geopolitical situations out there in oil prices. So joining me today, our founder and CEO, Jay Young, along with our EVP of Land and Business Development, Bill Phillips, and I think we will have our EVP of Tax joining us shortly, Rex Gifford. So hello, gentlemen. How are you doing today?
Hey, you're doing great.
Doing great. How are you?
Rex is doing my taxes right now. It's tax day, and he's doing my taxes right now. So I told him not to come out. Don't come out until you finish at least my extension.
Oh, so he might be in there for a long time. Is that what you're saying? He may never join us.
I just need the extension. That's all. But anyway, he's
just
busy.
Kidding. Well, Jay, here we are. We're still sitting. We're still looking at $90 oil, right? That fluctuation between $90 to $100 oil. What's keeping prices elevated right now? Besides, headline numbers itself, what's kind of going on out there? I'm honestly a little surprised they're at 90. I actually thought they would be higher.
I did too, and I've talked to a lot of different people. I've got 5 or 6 interviews a day, probably average, TV or news or radio. And today's only radio somewhere in a knit shirt. But anyway, they, and you're right. They've shut down the Strait, right? No oil and gas going through there. It's been weeks going through there. They've shut down a lot of production in the Persian Gulf. I mean, they've taken off 12 to 15 million barrels a day that's been shut down in the countries that go through the Persian Gulf, they go through the Strait. They've shut those wells in, and that's 12 to 15 million barrels a day, of production. Now, 20 million goes through there, but 12 to 15 million they've been shutting down, which means there's literally hundreds of millions of barrels that have been taken off the market, not produced. So those wells, that production is not on the market at all. Period. Zero, out. So that's a lot when you talk about several hundred million barrels. So you don't have that oil in the market right now, and there's got to be shortages anywhere and everywhere you look. China, Japan, India, these countries starving for oil. And we just can't get it to them because of the Strait. And, all these tankers, I got a call today from KTRH in Houston. They were like, what is going on with all these vessels coming to America empty? And I said, well, the reason why is because there's so much oil in Texas and the United States. I'm not saying we have a glut. We don't. We produce 13 million a day. We consume 20 minus 13, 7. We export 1 or 2 because we can't refine it all here because we make it. Anyway, we're getting 4 million out of Canada. So we don't have we're not overflowing full of oil. But these tankers are coming over to the United States because they're going where the oil is. It's kind of like the guy one time, he said, hey, let's go rob a bank. And he said, man, why do you want to rob a bank? And he said, well, because that's where the money is. And that's the same thing they're doing now with oil. They're like, hey, let's go to the United States. They got oil. They're not shut down. Let's go over there. Maybe we can get lucky and get some oil. So a lot of tankers coming over here. They're not going to – I don't think they're going to do any good, but it is what it is. But there is so much of a shortage in oil right now all over the world. You're right, Rachel. Why are prices only $90 a barrel? They should be a lot higher. And I believe they're going to be higher in the future. But I believe not only are they going to be higher, but they will be. They're not going to go down. Even if we said, hey, we're good and we get what we prayed for growing up, and we were praying growing up on our side of our bed and on our knees, and we said we want world peace. That's exactly what we wanted then. And if we had that today, we're still not going to see commodity prices going down. I mean, oil and natural gas. Natural gas hasn't really taken off yet. It will as soon as these AI plants are hooked up. But we're going to see commodity prices. I mean, it's going to be a great 3 to 5 year run here, King Operating and for other firms and what's going on in the world with oil and gas. If you're an investor in oil and gas, and you participate in oil and gas wells, if you have anything to do with that, you're going to be very, very happy. If you don't, and you want to go to the gas tank, you're going to be paying more money. I mean, it's just an offset deal. It's like sometimes in our portfolio, in our stock portfolio, we're so overweighted with oil and gas. When the stock market went down the other day, our portfolio went up because of oil and gas. And then my wife doesn't mention that, but all she mentions is, well, when prices are down and we lose money in oil and gas, but we made money in the market. She doesn't talk about the money we make money we lost. But anyway, you know how that works. But I'm just saying that oil and gas is going to be a great vehicle for people to invest in. And if you want to invest directly into an oil and gas project, I know who you can call. Right, Rachel?
Right. Give me a call. 214-8923. No, joking. So, but you can actually get us on kingoperating.com, fill out the learn more footer down at the bottom. But yeah, Jay, it's really funny. As I was talking to one of our current partners and investors, he said, it's painful at the pump, but secretly when I was filling up, I was thinking, well, I'm making more to offset this than other people that are filling their vehicles up. He was like, I felt bad, but secretly I was happy not to pay more at the pump, but because he knows his revenue checks and monthly distributions are really going to be weighted, with that $90, $95 a barrel price point over the last few months. So yeah, it has been very interesting, Jay. It's interesting to watch how when Trump says one thing, we see high prices. He says one thing, goes down a little bit. But as you mentioned, the true reality is there is a lot of disruption. We talked about this, I think it was maybe last time, about how even with a lot of these wells that they've had to shut in and stop production on in the Middle East, they may never come back online the same way.
Absolutely, 100%. I mean, I remember one of the wells that we had. It was a high-powered oil well, and it was out in Scurry County. It was our second well out there. Our first well was our test well, came in really good. Our second well was a monster well. I mean, literally just a monster. And it was producing like 1,500 barrels a day, about 2 million cubic feet of gas. It was really big, and it was bigger than we ever anticipated. And this well's roaring, literally, and so excited. But from the wellhead to the separator, there's a pipe that takes it from one to the next. It goes to the wellhead, then it goes to the separator, which separates the oil, gas, and water. Oil goes here, But anyway, this pipe was not poly. It was not steel. It was some type of in between poly and steel. And I got a call like at 6 in the morning, and it said that this pipe had burst, and there was oil literally all over this cotton field. It's in West Texas, cotton all over the place. The cotton turned black. There was no white cotton. It was all black. And I'm like, I did not care about the cotton, but all I cared about was shutting in that oil well, because if you shut a well in, especially oil and especially high pressure, like a Coke bottle, champagne bottle, chances are really good that when you turn them back on, they're not going to come back on the same. And this well came in about 60%. It came back on about 600, 700 barrels a day, unfortunately, but it was not as good as it was. You just don't want to shut wells in right now. You don't want to shut in any high-powered oil and gas well. Gas wells are different, I guess. I don't know that much about them, but you have oil overtaking the water, and there's just so many different things that can happen, and you just don't want to shut wells in at all, period. End of story. Go on and don't. But since they have over in the Middle East, you're right. I mean, they've shut a lot of these wells in, and since they shut these wells in, they're going to turn them back on. I guarantee you they're not going to come back at 100%. I mean, hopefully 70, 80%, but it's not going to come on at 100% because these wells just don't do that. No oil and gas wells will do that, unfortunately. And they're having to shut these wells in, and that's not good. Not good for them, not good for the business. It's going to be good for oil prices because it's still taking away inventory, and the reason why a price goes up and down is because of supply and demand, right? If you oversupply something, if you oversupply it, and it's a commodity. If you oversupply it, and the price goes down. If you undersupply it or you don't have enough of it, the price goes up, and that's exactly what's going to happen out here. When 3 months, 6 months, whenever we go back to world peace and we go back to going down the canal and everybody's happy, we're not going to have the oil that we had before, and the United States is going to have to look for different means of the world is going to have to look for different means of producing oil and getting oil from all across the world, because literally we don't have it. We're not going to have it. And who can you have to count on somebody, and it's hard to count on the Middle East for oil from now on.
Yeah, there's definitely going to be a chain reaction here in supply and demand, and seeing how that area kind of recovers. Definitely from our outlook, we know this will probably go into 2027, could go beyond, where we still see some elevated prices. But I really do wonder, Jay, it's so interesting just to think about those tankers that are coming to the U.S. I mean, like you said, we're still importing oil in the U.S. for ourselves. What is the reality of what they could actually get here in the U.S.? I mean, how much oil do we have to be selling to tankers for overseas right now? Yeah,
like I said, we don't export that much oil. We do export some, and I guess they're just wanting to be in line because they feel like I don't know. Like I said, I don't know why they're coming over here. It's not a party boat that's coming over here. It's a serious situation where they're bringing tankers that they want to go home with oil and or natural gas, LNG, and they're just not. We don't have any abundance. I mean, we produce 13 million a day. We need 20, if not more than that. So we're a deficit 7. We do get oil out of Canada and Mexico. So we're not reliant on the Middle East like we were at one time. At one time, we were at 6-7 million barrels producing here in the United States, and then all because of fracking and all because of the Permian Basin, the Bakken, the Eagle Ford. Those three right there right now produce a tremendous amount of oil. 5-6 million barrels a day, if not more than that, is produced from these three basins, which is great because demand is going nowhere. Demand is going nowhere. And as long as – now I guarantee if the price of oil was – if we didn't have the shale and we didn't frack and we didn't have unconventional, the price of oil would be $200 a barrel or $300. And, yeah, demand would go down because nobody could afford to do anything.
Right.
Oil goes into like 6,000 different products. 6,000. So it's not just for, jet fuel or gasoline. It's used for a lot of different products.
Bill, I just want to pull you into this conversation because, of course, you've been in oil and gas for a very long time. So kind of as we're just talking about what production is looking like in the United States, and all of a sudden, this huge magnifying glass on other parts of the world needing more oil, what is really in America as far as the basins that we have, the production we have now, how much availability is there to actually scale that production and see an increase of what we're producing here in the United States? Oh, Bill, you're on mute. There we go.
There still is quite a bit of room left. And Jay made a good point. He says, where do you get cash and you're a robber, you go to a bank to rob it. So where do you find oil and gas? The overwhelming majority of the fields are where oil and gas has already been found, and you have new skills, new technology, new fracking techniques. You try some that did not work before that now do, but you do those and explore in proven basins. So there's still an awful lot of oil and gas to recover. For example, even in the Permian, as many wells that have been drilled and with all the new technology, we're still are recovering only about, say, 10 to 15% of the initial drilling and production from the wells. And once you drill a well, a horizontal well, and it produces several years, that production declines, and at some point you'll go in and water flood it. That means putting water in the ground to push it toward a productive well, and when the water's done all it can do, you inject gas and have a tertiary project. So, and even with the tertiary projects, you're still only going to recover probably, I don't know, 40-50% at most. So that leaves half of the oil and gas is still in the ground. And as time goes forward, the technology that we have is getting better and better. Every 4 or 5 years, we make a leap forward. Just look at today. Before we had the ability to drill horizontal wells, production would be way, way down, kind of like Jay said. And today, we're able to expose more rock, productive rock, to the wellbore than we ever have been before. With new frac techniques, the same thing occurs. As technology increases, you're able to produce more and more, but still, the best we can do today is probably 40-50% of recovery. That means half of the oil and gas, at least, is still in the ground. And as we learn more, it will get better and better.
Yeah, that is amazing how technology keeps taking us down the path of continuing further production and development in the United States. So, Bill, when you actually are looking at, some developmental areas or the perspective of different lease acreage, what are factors that increase the value of acreage that you're taking a look at?
Sure. It's not just one, although some are a little heavier weighted than the others. One of the biggest factors that helps increase the value of acreage is the reservoir quality. If you can't get it out of the ground, what good does it do you if it's in the ground? So the reservoir quality, meaning the porosity and permeability, the little pore spaces in the rock, and the ability to push oil and gas through those pore spaces is being permeable, that's probably one of the largest. Another factor that increases value of the acreage is the ultimate recovery, or the EUR per well. Another big factor is the commodity price. The value of acreage is worth more if oil is at $100 than if oil is at $30 per barrel. Where the acreage is located. If you're in a highly productive area with multiple horizons, multiple zones, you have the same surface footprint, but you may be able to drill 7 or 8 benches like out in the Permian, as opposed to some areas where there's only 1 or 2 zones that are available for production. Existing pipelines in the area. The lease terms, for one. If you have a lease that has a 1/8 royalty like they used to when they first discovered oil, you got 87.5% of the revenue from whatever oil or gas you produced. And at a quarter royalty, you only get 75%. The regulations have an impact. Where are you? Are you on private land, or are you on government land, or are you on state land? All those things fit together, but probably one of the two biggest are the quality of the rock and the commodity price. If both of those are in alignment and doing really well, that same 640 acre tract will be worth more than if you had, let's say, a low oil price, or you had a high oil price and gas price, but the rocks were so tight it was really, really hard to get much out. So it's not just one thing, it's a combination of several, but those are kind of the high points of what might make a section of land more valuable than a section of land somewhere else that didn't have those attributes.
Yeah,
if that makes any sense.
Yeah.
That makes a lot of sense.
And I'll say this too.
Yeah.
I'll say this too, if you don't mind, Rachel.
Yeah. Go ahead.
Something very, very important that I learned this morning in our meeting, our King Operations meeting. But we talked about the Bivens Ranch, and we had talked about it first. We could drill maybe 100 wells or 150 wells on this 60,000 acres. Remember that, Bill? A long time ago we were talking about, hey, well, we can drill about 100, 150 wells.
Yes, sir.
And then all of a sudden, our engineers go back and say, well, we don't think you need to spread these wells out as far. Maybe you could drill wells, closer together because, your spacing requirements between wells. Maybe you could do 800 feet apart instead of 1,600 feet. Well, that doubles your number of wells you can drill. It doubles your reserves. It doubles. So at one time they're like, okay, well, we can probably drill 100 wells at and maybe the average is, 1 million barrels to 500,000 barrels. So let's just say you could average it out and say, okay, you can drill 100 wells in this acreage at 800,000 barrels. Well, that may be different because what if we went in and said, okay, now we can drill 200, 300, 400 wells and get the same EUR, which is that ultimate recovery. Man, that tells a great story, and that the acreage will get so much more money if you could drill 400 wells instead of 100. So there's many factors in that as well, but that was something that I had a smile on my face throughout my whole entire lunch with one of our clients, and I was like, yeah, man, guess what? This is going to be something. This is going to be something great. We haven't finished yet. We're going to drill a lot more wells in here, but in 2 years, we could be in the shoe business. And what I mean by the shoe is SHOE, meaning that SHOE stands for sell half of everything. So we could literally sell half of everything in 2 years and get all the clients all their money back and then we just continue drilling on the other half. So we sell half of it and then we drill the other half. So there's so many different possibilities out here, but once you find a really great rock, which is what Bill's talking about, that will give you an EUR of numbers that make sense, where your drilling cost, how much does it cost to drill and complete? How much is your leasehold? What's the EUR? And you can put that into the computer, or those engineers can put that in the computer and spit out a good internal rate of return to find out exactly, okay, well, every time you drill a well at $70 a barrel, you're going to get that's what we figured out in the Mid-Con section. Same thing. It's like we felt like we could drill a well, get the reserves at $70 oil, we're at 100% return. 2 to 1. So it's a great deal for us. As long as prices stay at $70, 100% return over time, man, we're doing really good for our investors. Now, I know at 220 we talked about getting Rex in here at 220. I don't know, Rachel, what do you want to? How do we pivot?
A message saying that Rex is not. I don't think Rex is going to make it. Today. So it is tax day, Jay, as you said. I think you mentioned you're filing an extension. Is that correct?
I am.
Yeah. On April 15th?
Yeah, until.
Love that.
Well, you get 3 more months and then 6 more months?
Yeah, that's right. Well, for us, of course, a lot of what we do does involve taxes, and it involves incredible deductions through intangible drilling costs. So I'll just mention that right now. And we will probably have Rex on later at some point to talk further about that. But if you did end up paying too much this year to the IRS and you thought, ouch, that really hurt, I'd rather not hand them over so much money next year, then you're definitely going to want to join us for Ed Lyon webinar, which we did have to reschedule. He had some personal scheduling issues. So we are going to be having that on the 28th of April. Make sure that you do reach out to us at kingoperating.com. And we'll send you that information to register. And we're going to be having Ed Lyon, who is a U.S. tax strategist, really share more about how intangible drilling costs work, how they can benefit you, and put about 30% of your investment back in your pocket year one, which is one of the best tax deductions available to accredited investors, something we specialize in. So you definitely want to check out that webinar on the 28th. Mm-hmm. Reach out to us if you would like to just learn more information about how we can help you offset some of that active income or any cap gains that you have. So, Jay, it's, I think we had a great last year, 2025, about 83% deduction for our partners in their year one investment. Pretty phenomenal. A lot of active drilling happening.
It was really great, and I'll tell you, people get really excited about the tax write-off, and that's what attracts a lot of people to oil and gas. They're like, well, hey, I can get a good write-off. But then when they look at our funds and see where we're drilling and see what the odds are and what's the return of what's the chances of getting your money back plus a better return with an oil and gas project, our project is second to none. I mean, our goal is to make the best investments you've ever made because of the tax write-offs and because of I'm working on some tax accountants now on some things to try to lower that to get more of a 100% write-off with debt. I'm working on that right now, but getting the returns that you can get and literally energizing your portfolio, very quickly, because it's like you get tax write-offs and we can increase the value of your property. If we have a good divestiture, one of the guys I met lately, he's like, I'm interested in looking at each one of if we drill 14 wells this year and we try to sell them all or sell some of them or whatever, he wants to look at that. And we're looking to, be in the shoe business again, but be in the, hey, if clients want to take advantage of us and give us back a lot more money than we have in it, man, we want to participate and have them participate in a divestiture at the end of the year. So not only are we going to, try to divest, but we're also going to, try to get clients their money back as fast as we can because, hey, we know what the game's like. If I give you a good return on this one, you'll reinvest with me later on down the road, and that's what we want to do. As sponsors and as we look at it, we put our own money in these projects just like everybody else does. And I don't have enough money in this last year, I think, because of tax and Rex doing my taxes right now. Rex, where are you? But anyway, he didn't advise me enough, maybe. But we don't want to pay tax. Nobody likes it. But I'm also saying this from the book that you see right here. I'm writing the second edition right now. The second edition is being written right now. The Upside of Oil and Gas Investing. Call us for a free copy of the book. I'll sign it and send it to you because it's just a great way to think about oil and gas and think about, hey, this is what drives. I looked up a minute ago. I wasn't looking at my phone, but I was looking at my phone because I wanted to know how many barrels of oil we're producing in 2010. Just think about that for a second. Okay, 2026, 16 years ago, 2010, the Rangers went to the World Series. But anyway, besides that, what do you think the production was? What do you think the production was in 2010? It's 13.4 now. This was 16 years ago. What do you think the production was? Bill, take a wild gander. You're muted.
Not yet, Bill.
Send us some hand signals.
Sorry, I would guess
signals.
7-8 million barrels a day.
7-8 million barrels. Rachel, what do you think?
2010, I'm going to go with 5.
5.5. 5.5 barrels a day. I mean,
Sorry, Bill.
Bill, I'm with you though. I would have thought it would have been 7 or 8 million barrels a day, if not more. But then when horizontal drilling came in the Eagle Ford, the Bakken, and the Permian, and they started fracking, now we're at 13.5. Now let me ask you this question: if we didn't have horizontal drilling, this is a good lead-off webinar question. If we didn't have horizontal drilling and fracturing, multi-stage fractures, where would the price of oil be today? Now that would be way up there. It would be triple digits for sure. So you can thank the oil and gas people. You can thank the oil and gas people for only paying $4 at the pump, literally.
That's right.
All right. Well,
It would be much different. It would be much different. It is actually amazing. Wow. All right. We're already at 2:31 today. I need to mention also that next week we will not be live. We have a company-wide meeting that we have going on here. So join us in 2 weeks for the oil and gas rundown. And then, of course, again, kingoperating.com. You can reach us there, learn more, and register for that tax webinar that is coming up on the 28th of this month. So, gentlemen, thank you so much for joining me today, and we'll see everybody in 2 weeks.
Absolutely enjoyed it, Rachel. As always, Rex, he still didn't. Maybe he's got that pencil out. He's got that pencil out and he's erasing my tax returns, maybe? I don't know. Anyway.
I'm sure he's in there whizzing up some great things for you, Jay.
There you go. All right. God bless.
Guys, see you later.
Yep.
Bye-bye.
Bye.